Welcome to the Deep Dive. We sift through the noise, find the insights, and give you what you need to know.
And today, we're digging into Procter & Gamble.
Exactly. Their fiscal year 2025 fourth quarter earnings call. It was pre-market, July 29th, 2025.
And it gave us, well, quite a mix, didn't it? Solid results, but also some real caution looking ahead.
Yeah, it definitely feels like they're heading into a pivotal transition phase for such a huge company.
Absolutely.
Okay, so let's maybe unpack this. Start with the headline numbers. Give us the quick snapshot.
Sure. So P&G delivered a pretty strong beat, actually, both top and bottom lines for Q4.
Okay.
Core earnings per share, that's the one stripping out, unusual items, hit $1.48.
$1.48. And how does that compare?
That's up a solid 6% year over year. And it beat the consensus estimates by about 4%.
Okay, 4% beat on EPS. What about revenue?
Revenue came in at $20.89 billion, so up 2% year over year. Also a slight beat there.
In organic sales.
Matched that 2% growth. So consistent performance from the core business.
Okay. And looking at the full year then, did they keep up that kind of pace?
Pretty much, yeah. For the full fiscal year 2025, core EPS landed at $6.83. That's up 4%.
Right.
And organic sales also grew by 2% for the full year.
Steady growth.
Right. And importantly, they showed really robust cash generation. They returned $3.3 billion to shareholders just in Q4.
Wow.
And for the whole fiscal year, $16 billion. That's through dividends and share repurchases combined.
$16 billion. That's a serious return of capital, especially when they're talking about volatility.
It is. It shows discipline. So yeah, overall, you could say a resilient performance in what management themselves called a volatile environment.
Okay, so those are the numbers. But, what's the story behind the numbers? Let's peel back the layers a bit. The qualitative stuff, the strategy shifts, the guidance. That's where it gets interesting, right?
Absolutely. And what's really fascinating, I think, is the underlying narrative here. P&G is, they're openly acknowledging significant consumer pressure. Well, their CFO was quite specific. Said U.S. shoppers are delaying purchases. They're using up what they've got in the pantry first.
Using up a stock.
And actively looking for deals, really hunting for value.
Which makes sense in this environment, but how does that connect deeper?
It ties directly into some, honestly, surprisingly low consumer satisfaction scores they mentioned in key categories.
Like what?
Get this. Only about 25% of consumers are satisfied with laundry detergents.
25% for laundry. That seems fundamental.
Right. And it gets worse. 50% are unhappy with diaper performance.
Yeah. Oof.
Yeah. And just 30% of women are satisfied with their period protection products.
That's a huge gap. I mean, it's obviously an opportunity for them, but it's also a massive challenge, isn't it?
Okay.
Especially with private labels breathing down their necks.
Exactly. It signals maybe even their premium products aren't hitting the mark for a lot of people, which is tough when competition, especially from store brands, is intense.
So how are they planning to tackle this dissatisfaction, the competition? What's the game plan?
Well, their strategy really boils down to three things they kept hitting on: superiority, productivity, and an agile organization.
Okay. Superiority, productivity, agile. Let's break that down. Productivity first.
Right. The big news on the call, underscoring that productivity push, was a planned restructuring.
Details.
They're aiming to cut approximately 7,000 non-manufacturing jobs by 2027.
7,000. That's what percentage is that?
It's roughly 15% of that specific workforce. So significant. And they also plan to exit some underperforming brands as part of this.
And the goal there is cost savings.
Well, yes, but they frame it as productivity uplift. They expect it to deliver about $1.5 billion over time.
Okay, $1.5 billion. That sounds like more than just cutting costs, though. It's like they're building a war chest, maybe, to fund the superiority part. Address that satisfaction gap.
I think that's a great way to put it. It's not just saving money, it's freeing up resources to invest back into innovation, into making those products demonstrably better. It feels very integrated.
Right, makes sense. Okay, so speaking of big strategic moves, the leadership change, that definitely caught my eye.
Indeed. Big news there, too. CEO John Moller is transitioning to executive chairman. That's effective January 1, 2026.
And taking the CEO spot.
Is the current COO Shailesh Jejurikar.
Okay. What's the background there? Is this a sudden move?
It doesn't sound like it. Moller really emphasized Jejurikar's long tenure, 36 years at P&G. He led fabric and home care, enterprise markets, huge parts of the business.
So deep experience.
Exactly. The message was very much, this is plan, it's about continuity, not a reaction to anything, passing the torch deliberately.
Got it. Okay, so lots happening internally. But what about the external pressures? You mentioned volatility. Tariffs seem like a big one looming.
Oh, definitely. And they addressed it head on. Management said they will be raising U.S. prices.
On what?
By mid-single digits, but not across the board on about 25% of their SKUs, starting in August.
And that's purely to offset tariff.
Pretty much. They estimated a $1 billion hit from tariffs for fiscal 2026.
$1 billion? Wow. Where's that coming from?
It breaks down like this. About $200 million from stuff imported from China to the U.S., another $200 million from Canadian tariffs on goods shipped from the U.S.
Okay.
And the biggest chunk, $600 million, from tariffs on goods coming into the U.S. from the rest of the world.
And that $1 billion impact, how does that translate to the bottom line?
They expect that tariff headwind alone to be a 5-point drag on core EPS growth next year.
5 points. Okay, that's substantial.
It really is.
So putting it all together, consumer pressure, the restructuring, new CEO coming, these big tariff hits, what does their actual forecast look like for fiscal 26? Must be pretty cautious.
It is. For fiscal 2026, the guidance for organic net sales growth is 1% to 5%.
1 to 5. That's quite a wide range, isn't it? Wider than usual for them.
It is, yeah. And that really reflects the significant market uncertainty they're navigating.
Okay. And EPS.
Core EPS guidance is between $6.83 and $7.09.
Which translates to
0 to 4% growth. So potentially flat year over year at the low end. And the midpoint is just slightly below what analysts were expecting.
Right. Does that guidance factor in anything else major? Costs, FX?
Yeah, it includes about $200 million in commodity cost headwinds, so costs still rising a bit there. But also, interestingly, a $300 million foreign exchange tailwind.
Oh, okay. A slight cushion from currencies.
A little bit, yeah. And on the cash return front, they plan to keep that going, aiming for around $15 billion back to shareholders next year.
Okay, so still returning a lot of cash despite the headwinds. It definitely sounds like, as you said, a year of careful navigation.
Exactly. Threading the needle, as you put it earlier.
Now, let's connect this to the bigger picture for investors. How did the market react? You'd think a beat would get a pop, but...
Well, it was pretty modest. The stock barely moved in pre-market trading right after the call, up maybe 0.15% or something small like that.
And how was it doing before the release?
It was actually down about 6% year-to-date before the call. Meanwhile, the broader consumer staples index was, relatively flat.
So underperforming its sector going in, and then a muted reaction to a beat. What does that tell you about market sentiment?
I think it screams caution. Despite the Q4 beat, the market is clearly focused on that forward guidance.
The conservative outlook.
Yeah, especially the tariff impact. That 5-point drag on EPS growth is hard to ignore, and the whole story around slowing consumer demand. Analysts mostly kept their ratings like moderate buy or outperform, but the price action shows the market is tempering its enthusiasm.
So the beat was nice, but the future looks challenging.
Okay, so given all this slowing demand, trade headwinds, private labels nipping at their heels, how is P&G actually positioning itself to get through this? What's the strategy beyond just restructuring?
They're really doubling down on what they call their integrated growth strategy.
Integrated growth?
Meaning it's a really strong focus on innovation to drive growth within their categories, not just taking share.
They gave a few. Pampers growing nearly 20% in China, which is huge. The launch of their super premium SK2 LXP line. New stuff like the Swiffer Sweep and Mop Deluxe, and significantly, Tide Evo.
Tide Evo, right. That's their new tile format.
Exactly. And they're not just talking innovation. They pointed out they had 4 of the top 10 most successful non-food product launches in 2024, according to Circana. So they still have that innovation muscle.
Okay, so innovation is key. How does productivity fit in again?
Productivity improvements are crucial for funding that innovation. They're looking for up to $500 million in gross savings just from cost of goods, improving the supply chain operations.
Right.
And that big restructuring plan we talked about, that's central to creating the financial headroom needed for these big bets on R&D and marketing.
And didn't they also mention something about lower inventory being actually a good thing, even if it hurts sales numbers short term?
They did, yeah. The idea is that lower inventory across the whole system, retailers, distributors, while it might impact their sell-in numbers temporarily, it ultimately makes the whole supply chain more efficient, reduces costs everywhere.
So it's about long-term health over short-term bumps. Makes sense.
Exactly. Optimize the system. So looking ahead, the things investors should probably watch are the early impacts of that restructuring. How quickly do savings show up? How do those price hikes land in Q1 of fiscal 26?
Yeah, consumer reaction to prices will be huge.
Absolutely critical. Plus, any changes on the tariff front, obviously. And then that CEO transition in January 2026, that's a key moment. Could bring new energy, a different focus maybe into this whole transformation phase.
It really feels like a pivot, doesn't it?
Yeah.
Shifting maybe from just chasing volume to focusing more on margin expansion driven by that innovation you mentioned, almost like a reinvention.
I think that captures it perfectly. Calculated strategic moves for the long haul.
Okay, perfect time then for our This Is Not Financial Advice segment. This is where we throw out an outrageous but maybe plausible trade idea. Think hedge fund brainstorming, purely hypothetical.
All right, let's have some fun with it. Given everything we've just heard from P&G, here's a bold one for you.
Lay it on us.
Consider going long P&G paired with a short position on a basket of companies focused mainly on private label manufacturing, or maybe value tier consumer staples players.
Ooh, okay. Long the premium incumbent, short the value players. That's definitely gutsy in this environment. Walk us through the thinking there.
Okay, so the thesis hinges on that consumer dissatisfaction we talked about.
Yeah.
Yes, people are anxious. Yes, there's some trading down now. But those low satisfaction scores in laundry, diapers, that's a massive, massive opening for premium innovation.
Right, the superiority pillar.
Exactly. P&G is committing hard to what they call irresistible superiority through serious R&D. Look at Tide Evo. It carries a 50% price premium, apparently. And in test markets, it was highly incremental, meaning it grew the whole category, didn't just steal share.
Okay, so innovation can justify the price. Even now.
That's the bet. The restructuring gives them the cash to fund this innovation pipeline aggressively. And yes, tariffs hurt, but the fact they feel confident enough to pass on mid-single-digit price hikes on a quarter of their products, that suggests pricing power.
And the short side, the private labels.
The idea there is that while private labels benefit from the short-term value hunt, they fundamentally struggle to match P&G's level of R&D and innovation. They can copy, but can they truly delight the consumer in the same way? The risk for them is long-term commoditization, margin pressure, while P&G, if the strategy works, uses superior products to drive category growth and justify its premium prices.
So betting that P&G's innovation overcomes near-term price sensitivity and leaves the value players behind.
Interesting. Definitely plausible, definitely bold.
It's a thought experiment, right? Betting on quality and R&D winning out.
Yeah.
All right, so wrapping things up today, we've dug into Procter & Gamble's Q4 and full fiscal 2025 results. And it really paints a picture of a giant navigating some tricky waters with real strategic intent.
Yeah, they delivered that solid beat, but the outlook is cautious, no doubt about it. It's underscored by big moves, the restructuring, the CEO transition. The focus is clearly on driving that superior innovation and getting leaner operationally to fund it.
Even with those macro headwinds tariffs, shaky consumer confidence, they seem to be banking on innovation to earn their premium status and actually grow their categories again.
Proving perhaps that even in a tough market, quality and strategic agility can make the difference.
Absolutely. Now remember everyone, this deep dive, including that trade idea, is purely for informational purposes. It is definitely not financial advice.
Please always do your own research, your own due diligence before making any investment decisions.
We really hope this breakdown gives you a clearer picture of P&G's path forward and maybe the broader consumer staples landscape too.
Yeah.
What really stood out to you from our discussion today?
Yeah, are you buying into P&G's innovation story, or do you think price sensitivity is just too powerful right now? We'd genuinely love to hear your thoughts.
Thanks for tuning in to The Deep Dive.